Hello guys, this is stock market secret, which is 2% rule. So guys, let me introduce myself. I'm Priyesh Raj and I'll be talking to you about the 2% rule and what is that and why is it secret. Okay, why more 90% of the trader fails and why only 10% wins. Out of 10%, the 5% or consider 8% is big hedge fund companies, and only 2% of the people make money into the stock market, guys. This is the bitter truth, but try to understand and try to digest it. If you want to become successful, then you need to follow this rule. So guys, let's begin. So guys, in this 2% rule, this is a basic trend of risk management. I prefer this term risk management or capital preservation as they are more descriptive than money management. Even if the odds are stacked in your favor, it is not advisable to risk a large portion of your capital on a single trade. Larry Hitt in Jack Squaggers of Market Wizard. Guys, if you have not read this book, Market Wizard, I will highly recommend you to go and check this video first. Read this book. Mention two lessons learned from my friend. Never bet your lifestyle, never risk large chunks of your capital on a single trade, and always know what is the worst possible outcome is. Hitt goes and describe his 1% rule, which he applies in a wide range of market. This has since been adopted by short-term equity traders as a 2% rule. Okay, he always use 1% capital. Okay, this means that the run of 10 consecutive losses would only consume only 20% of your capital. It only does not mean that you need to trade a 50 per different stocks. If you use a stop loss such as ATR trailing stop loss, your capital at risk is normally far less than a purchase price of the stock. It means guys, you need to only take a risk of 1%, okay, out of your 100%. So out of 10 trading days, you will lose only 10% of your capital, not the entire. Okay, now how to apply this 2% rule, guys? Calculate the 2% of your trading capital. Okay, now deduct the brokerage and buy and sell to arrive at your maximum permissible risk. Calculate your risk per share, deduct your stop loss from the buy price and add provisions for your slippage, and not all stops executed at actual limits. For short trade, procedure is reversed. Deduct the buy price from the stop loss before adding slippage. The maximum number of shares is then calculated by dividing the maximum permissible risk by risk per share. Example, your capital is 20,000, so 2% is equal to 400 per trade. Deduct the brokerage, buy and sell, and your maximum permissible risk is 400 minus 2 into 50, that is 300. Okay, now calculate your risk per share. If your stock is priced is $10 and you want to place a stop loss at 950, then your risk is 50% per share, and slippage is 25%, and your risk per share increases to 75% per share. Therefore, the maximum number of shares that you can buy is 300 upon 0.75 equals to 400 shares, okay, at a cost of 4,000. Okay guys, now, to adopt this rule of your trading style, not all traders face the same success rate or reliability, as a Von Tharp calls it. I will highly recommend you guys to go and read the Von Tharp books. It is a very highly beneficial for me. I have read all of it, and trust me, I am far more successful than this. And because of it, I am successful, guys. And I'll highly recommend you to go and read all its books. The short-term trader usually achieves higher success rate, while the long-term traders generally expect a greater risk-reward ratio. Success rate. Your success rate is the number of winning trade expressed by the percentage of your total number of trade. So here is the success rate. This is a winning trade. This is a winning trade plus losing trade into 100%. Now risk to reward. Your risk and reward is your expected gain compared to your capital at risk at early age. Now the risk and reward is ratio is normally expressed if the average gain is after deducting the brokerage, the winning trade is $1,000. You have consistently risk 400 per trade as in the earlier 2% rule. Then your risk and reward ratio is 2 is to 5 to 1. Okay, or 1000 upon 4, that is your risk to reward ratio, guys. Now let's talk about the confidence of this level. If we have like three traders, consider as A, B, C, this is the time frame, this is the success rate, and this is the risk to reward ratio. One is using 1%, another is using 3% risk, and another is using 10% risk. Okay, what happens in the long term? The person who is using 10% has only 25% success rate. A person who is using 3% risk has a 50% of success rate, and the person who is using 1% has a success rate of 75% for the short term. Now guys, this is the uh, data that we have collected, and this is the actual data that performs like a data for the short term average 125% over all his trade. Like the winning trades are 75%, that is equals to 1, that is 0.75. Losing trade is equal to 25%. Now average profit is equal to 50%. Okay, now trader B has a 100%, okay, capital at risk. Okay, now this is the capital at risk, guys. Try to understand this is the winning trade, this is the losing trade. Now the average profit equals to 1. Okay, so as percentage of capital risk is at 100%. Now trader C, in long term average, he has a 325% of the profit of his overall trade. So how he does that? The winning trade is equal to 25%, now equals to 10, that is 2.50. Losing trade equal to 75%, that is 0.75. Average profit is equal to 1.75, and the percentage risk is 125%. Guys, this does not necessarily mean that trader C is more profitable than A. Trader A is a short term, is likely to make more trades than trader C, and you could obviously you can see that is a long term trader, is a short term trader. Okay, but the time frames, okay, average profit, average trade times, or return of the capital, this is the entire data, guys. If you focus on this, you will definitely come to understand that how should I need to work. Okay, and if you have not watched my ledger series, okay, of a trader's goal plan, I'll highly recommend you to go and watch that video first before you come back, before you enter into the stock market. You need to have a proper direction, proper plans, proper goals, proper time limit. If the market does not work out in a limited time period, then quit it. You need to go back to your old jobs and then find it out that actually what works for you, right? So guys, this does not necessarily means that the trader is a profitable than A, and trader A is likely to make more profit than trader C. You can see that this is the data, guys. Now relative risk. Now we calculate the relative risk that each trader has, that is 20% dot round, which is a binomial probability calculator. Guys, I will highly recommend you to go and check this links out. Okay, this is STP the warstar.net and textbook.c. This is the link which is very important, guys. Now you need to understand that this is very very important, guys. You need to see now, guys, in the above data you see that trader A has a 75% success rate and B 50%, 325. The probability of the 10 straight losing is 0.001, 0.1, and 5.6. So obviously the higher success rate, the greater the percentage that you can risk on each trade. Bear in mind that with high risk and reward ratio, trader C only needs one win in 10 trades to break even, while trader A would need a 5 wins. However, if we compare break even point, it is still clear the lower success rates are more likely to suffer from the dot round. So guys, this is very important. Okay, the number of wins out of from the 10 trades. A has a 5, he has a 75% probability of net loss, or 10 to 2%. Now B has this rate, and now C has this rate. Okay, now you guys, you need to understand what is the data and what is the advantage. Okay, it is very clearly mentioned over this. I don't need to speak it to you. Okay, now the low success rate. Now let's talk about the guys trading in the real world. Okay, gains are not always equals, some losses are bigger than other, so stop loss occasionally fails when the prices gap up or gap down. Probability varies. Okay, the outcome influence each other. When the stock falls, and they tend to fall together. Now guys, for this we need to have a covariance. Okay, it is something that is not manageable. The biggest loss of the risk management system is that the stock movement influences each other. Individual trades and are not independent in the market. It march as a unison, and individual stocks follow off a course of their mavericks. Okay, stock that rises in a bear market or collapses in the middle of the bull market, but they are a handful. Majority follows in the stock of shapes. Thomas Dovey is a point figure charting that, for example, affecting the typical stock, that is market risk, sector risk, and sector stock risk. Okay, this is what we need to follow, guys. The risk of the market is moving against you is clearly the biggest single risk factor. Now how do we protect against this, guys? You need to protect your capital from the string of losses. That is, the 2% rule alone will not protect you if you are holding a large number of banking stocks during an asset bubble, insurance stocks during the natural disaster, or technological stock during the dot-com boom. We need to quick rule thumb to measure the exposures of a particular industries or market. Like guys, you see how the overall the market reacts with the sentiments. Okay, this is the US data. and this is entirely all segment has performed like this. Even if you look for the Indian market also, there is the same data. Okay, it performs everything like that. Okay, nothing has been changed. Okay, now guys, I would like you to highly go and read this sector risk, okay, and market risk, guys. Thank you for watching. Best wishes, happy trading, guys.